Hi, we're talking about Your Money Matters on NDTV Profit, and today I'd like to talk to you about a big change in the mutual fund space. It has to do with the way that the cost is calculated for you, the investor, when you invest in mutual funds. Now, you probably heard the term total expense ratio. This essentially covers all of the costs that you bear as an investor. That is now undergoing a change. It is now going to be made up of 4 components, and I'll list them out for you. There's going to be the base expense ratio, there will be the brokerage, there will be regulatory fees and statutory fees. All of this was more or less morphed into one earlier. Now there is a division between these two. And to facilitate this, the SEBI has said that the base expense ratio will be reduced by 10 to 15 basis points for most equity mutual fund schemes and certain other schemes as well. What else has happened is for those schemes that had an exit load, there was a special allowance that was given to them of about 5 basis points. And the SEBI has said now it's been enough time. It was supposed to be a temporary measure. It actually lasted for more than a decade, and they've said remove this. So that has happened. And the brokerage that I mentioned that is part of those 4 components, the SEBI has reduced the cap that is allowed for these mutual fund schemes so they can charge less to you, the investor. It used to be 12 basis points with levies. It has now become 6 basis points for cash transactions without levies. And so if you account for the levies, effectively the difference is about 4 basis points, 4.3 to be exact. Now, what is the result of this? You have a situation where the cuts for the base ratio are between 10 and 15 basis points. For open-ended schemes, for closed-ended schemes, there are between 20 and 25 basis points. Now, all of this sounds pretty complicated. So let me give you an example. Take a look at this table. This is for an equity mutual fund scheme that has an assets under management of 55,000 crore rupees. And so it's pretty much in the highest threshold for the calculation of expense ratio. Now, the expense ratio actually moves in slabs. So it starts with less than 500 crore, which allows for the highest expense ratio, and then it keeps reducing as you go up the value chain in terms of assets under management till you reach above 50,000 crore rupees. But the expense ratio that is charged on the whole is actually a blend of all of these slabs. So in this example, earlier the expense ratio was 1.31%. It now becomes 1.21%. The exit load allowance that was allowed earlier, at 5 basis points, it goes away. GST on management fees, and here we're assuming that management fees is about 55 basis points. That would be 10 basis points, but that shifts to your statutory fees and taxes, and everything else also shifts to that, all your GST, etc., and your STT. And finally, your brokerage has been capped at 6 basis points. So ultimately, the difference between the two can range anywhere between 4 basis points and 9 basis points. This is supposed to explain to you how this works. Now, do remember that this is for a very large scheme. It's quite possible for a smaller scheme, the difference could be wider. But all told, it's not too much of a difference seemingly on the cost. Let's talk about how this affects you though. So hopefully that explains to you how this change is going to take effect. But how does it affect you as an investor in mutual fund schemes? Let's talk about this with Harsh Kumar, who is a CFA and managing partner and co-founder at Zvest Financial Services. Harsh, thanks so much for taking the time. And I know that both of us, you and I, because I called you yesterday in the evening to try and figure out how this works. You and I have done quite a bit of back of the envelope calculations or Excel sheet calculations. Ultimately though, the crux of the bottom line is, how does it affect the individual mutual fund investor?
So, Alex, there are 2 impacts here. One is talking about the numbers per se, which you very well explained. And second is the psychological part of it. Now, this is an industry which works on trust, and investors' trust or unit holder trust is prime for anyone involved in this business, be it about asset manufacturers, be it about intermediaries. All of us have to win the trust of the investor, and the kind of growth we have seen in this industry is because of that. Just to take a step back and set the perspective right, in last 10 years, mutual funds have seen a CAGR growth of 20%. In last 5 years, the growth has been 22%. And right now we are talking about an AUM of around 80 lakh crore plus. Now, in this scenario, the more transparent we become, the more clearer we become in terms of our calculations, our numbers, the unit holders are going to trust us more. Now, the numbers in terms of impact change as far as benefit to the investor is concerned is say 6 to 9%, 0.6 to 0.06 to 0.09%, or rather 6 to 9 basis point. But the trust of the investor comes into this picture because investor feels that whatever I am paying as an expense ratio, I am getting a clearer picture on what is going where. Second advantage is that tomorrow, if there is a change in GST, there is a change in statutory levy, then I should not be holding fund house responsible, or I should not be feeling that fund house is charging me extra, because there is a clarity that fund house is charging me base expense ratio. On top of it, whatever is happening is very much managed by the regulator and government authorities, and I'm not paying anything extra there. So from that point of view, I feel this is not an issue of a cut, but more of a clarity. And I think I'm very happy about it because all people involved in the chain will have a clearer picture on where the money is going and how is it going. Second thing I would want to touch upon is fund houses which have low churn versus fund houses which have higher churn could also have a difference in the total expense ratio now, because you would have a situation where brokerage being paid is higher by a fund house which is running a higher churn, and the investor can take a measured call on which fund to invest basis all these parameters.
Is it brokerage that would get impacted, or is it because that brokerage is capped, or is it your statutory fees that could get impacted? Because one would assume that if you're churning a lot, you're selling and buying a lot, and so your securities transaction tax and your other statutory fees that you would pay per transaction would go up, wouldn't they?
Yes, absolutely. So overall, you are paying the same base expense ratio in two comparative funds with similar size, but one fund on account of higher churn ends up charging you higher total expense ratio, which rightly you explained that it is on account of higher statutory levies as well.
Okay, so therefore, I think the crux of this, Harsh, is not an attempt to make this cheaper. In fact, if anything, in that circular, the SEBI is very clearly stated that it has adjusted the reduction in base expense ratio to ensure that it wants to primarily pass through the effect of removing the statutory levies from here and moving it to the other side. It's reduced it to that extent, more or less. Is that the right way to look at it? And its primary objective is transparency.
Absolutely. So if I go by the intent of the circular and the way it was implemented, so for example, the discussion paper which came in October versus now, SEBI has listened to the parties which were involved, and there have been good number of changes which have been made versus the circular which was released, versus the white paper which was released in October. And that has only happened because the voice of the industry was heard. And from that point of view, I feel it's a good regulation, not just from investors' point of view, but whatever industry had requested in last 1.5 months, that has also been heard.
Interesting, because that sticking point, I think, Harsh, from my perspective, was that brokerage fee, right, on cash transactions in particular. Because the consultation paper that you referred to, which came out in October, had suggested bringing it down to from 12% cap, or rather 12 basis point cap, which includes statutory levies, to 2 basis points without statutory levies. And that was a dramatic drop. What has actually come about is a 6 basis point cap, which is a middle ground, so to speak. How much of an impact will this have? Because ultimately, the caution or the concern that the regulator had was that as a mutual fund house, you are supposed to have a fund manager, you're supposed to have a research desk or a team that looks at the investment thesis, has your own research, and on the basis of that, you're supposed to take a call. Whereas some fund houses were paying brokerage charges because they were getting research from outside. And ultimately, the regulator was saying, we don't want the investor to get double charged.
So again, Alex, I would just want to take a step back and explain how the nature of this industry is. So if you look at 80 lakh crore AUM, which I mentioned earlier, roughly 50% of this AUM is concentrated in top five fund houses. Now, as you speak during the day with other fund houses, you can check with them how much do they actually pay to institutional broker. While I do agree that out of 46, 47 mutual fund houses that we have in India, I'm sure majority of them were earlier paying 12 basis point, but I'm fairly certain that the top mutual fund houses would have been paying anywhere between say a 5 basis point to 7, 8 basis point and not 12 basis point. So from that point of view, uh, with the fund houses of certain size, maybe they were actually not paying 12 because it was up to 12 and it was not minimum 12 or mandatory 12. Second thing, the circular very clearly explains that it was not actually the number was not 12 but 8.59 which was being paid, and now that 8.59 has become 6. So my sense is that that is the reduction, but like you mentioned, it is much better than what was the scenario earlier. Now let's see the impact of this. So we can't undermine the sell side research or the research provided by institutional broker also, because that is also very important part of mutual fund performance. And why I say so, because there are people who are employed with institutional brokers who have been tracking one or two sectors for last 20, 25 years. They have a lot of knowledge about that sector and their opinion matters. So from that point of view, today a fund house which is smaller in size, they will have to negotiate with them in terms of excess of their report or research, and they may have to pay something which could be relatively higher as a percentage of their AUM than what a big fund house might end up paying. So my sense is the impact of this would be twofold. Smaller fund houses would have slightly lower access to research than what bigger fund houses would have. Smaller fund houses may have a little higher hit on their balance sheet than what the bigger fund houses would have because they were already not paying 12 basis point as far as my understanding goes. And thirdly, you mentioned about in-house research. Now, in-house research is possible, but imagine this is a business of economies of scale. Now, imagine I am a person who has been tracking pharmaceutical sectors and a niche in pharmaceutical for last 15, 20 years. And if I can share my research with 10 or 15 mutual fund houses, at the end of the day, economies of scale play for the benefit of the end users in terms of funds creating alpha with respect to that. But today, after this change, if that access gets restricted, I'm a little worried about research capability, especially of those fund houses where the AUMs are not very huge.
Okay, that's a counter argument that you have there, and it must be said that it's a pretty strong argument. But I would argue on the other side that one would expect that even smaller organizations will build out capability over a period of time and having in-house resource. And ultimately, I will give you a number of examples of schemes that have chosen to have a certain size or have chosen to spread themselves only to a certain point, to say that I will only have a flexi cap fund, and you probably know what I'm talking about. But you have
You're right.
one offering, but you have a good offering, and you will build out the team that will be needed to serve that. So why do you want to create 16 different schemes, not have a team that will do enough research, and then have to do it from outside, which has a bearing on cost, which has a bearing on quality? And ultimately, if the same research is available to 15 fund houses, then what are you doing differently that requires people to come to you as opposed to somebody else?
So absolutely. So now there are 2 points to that. If you look at most of the fund houses, be it smaller or big, the number of stocks they cover is generally 10 to 15% of the total universe available. So assuming there are 4,500 to 5,000 listed companies available in India, the universe is generally confined to 400 to 700 stocks, depending on the fund house. Now, coming to your second part, that if all have access to that research, it's not that they would rely on that research exclusively. Now, after getting research analysis from the broker, they would have their in-house processes to figure out whether they want to go with that hypothesis or not, and then what kind of a weight they want to assign to that stock. So it's not a very simple way in which the schemes work and in which the decisions are taken. It's a little complicated way how the hypotheses are arrived at, but I would be very happy if most of the fund houses have their own in-house research desk, which are capable enough to track 500 to 600 stocks. Because when that happens, then you will see true differentiation between multiple fund houses. And when you were mentioning about that there won't be much of a difference between two or three fund houses who use the same research report and apply the same decisions, I agree with you. So you would see a lot of funds in the industry as well, which are benchmark hugging, some funds in the industry
Yeah.
where the returns are not differentiated. So you have a valid argument there, and I hope that changes.
Yeah, exactly. I hope that this, Harsh, is the factor that galvanizes these fund houses to look for talent and to look for research capability. If anything, that would be a good sign for the investor at the end of the day. So thanks so much for joining me on this conversation. Pleasure having you as always, and look forward to the next chat.